Hey there. Hello. You're watching Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is the place that you go to learn about personal finance, investing tips, business talk, and other related matters. And one of the things that we want to do here is to make sure that you are protected, that you are not getting pulled into the stock of the day or the investment trend of the day or whatever hot thing is out there, because we see it all around us. We saw it with crypto up and it blew up. We saw it with pot stocks. I think Tilray was like a $600 stock, and now I think it's under 10 now. And we see it now happening with other stocks like Virgin Galactic and Nikola Motors. There's a lot of froth out there, folks, and I think people were starting to think that making money in the market is easy. The get rich slow scheme that I like to call it, your winning lottery ticket, does exist. It's just that it'll take 20 or 30 years to get your winnings. If I could promise you a lottery ticket that you're going to win $1 million. Let me repeat that because I like the way that sounded. I have a itch in my eye. Yeah, I know it's this live stream. Let me say this again. If I told you that you have a winning lottery ticket and you're going to claim $1 million or more from this lottery ticket, you would be so stoked. You'd be all over that. You'd be like, wow. The only thing you have to do, though, is you have to hold on to the ticket in a safe place for the next 20 or 25 years and follow these instructions. Invest regularly. The money that you invest every month, you invest first and then spend the rest. Don't go trying to spend and to pay for your lifestyle and your monthly bills and then say to yourself, I'll save whatever's left over. Because how many times do you get to the end of the month and nothing is left over? You want to save before you get your hands on your money. This way you won't miss it, and it'll create that saving and investing habit that you need to develop in order to build your wealth. If you can do that, invest with a very hands-off approach. Spend less than what you make, and you've got yourself a winning lottery ticket, my friend. Yeah, I know there's no promise. This is all about potential. And could the stock market be lower 20 years from now? It could. But I'm willing to take that chance because I know that everything is going to cost more based on history. That's why I say that. Healthcare, food, the things we enjoy. Look at the price of a house today compared to 20 years ago. Look at the price of a car today compared to 20 years ago. Imagine in 20 years what things are going to cost. Warren Buffett once said this about the stock market. If you think the stock market is expensive now, wait until you see how expensive it's going to be in 20 years. That's what this show is all about. Personal finance, building good spending habits, developing good spending habits, developing good investment habits, understanding things like tax deferred versus tax free, understanding how you can use an UTM account or a 529 account to save for your child's education, but which one's better? I think the 529 plan, things like that. That's what we talk about here on this show. But I want to talk to you today about SPACs. What the hell is a SPAC? Special purpose acquisition company. It's the latest rage. Everybody is going gaga for this. Is it worth it or is it just a fad? That's why I brought up crypto and pot stocks, because this money seems to be moving in and out of different places and creating bubbles and then creating busts. So let me just roll the quick intro. We're going to talk about SPACs. What are they? Should you consider them? And I just want you to know this. So when you start hearing all about this stuff, this topic, that you don't get sucked into it, that you can make an informed decision. And if you decide that this is for you, great. If you decide it's not for you, that's great too. But at least you'll have some information to make that decision. Let's get into it. This is going to be good. Hello, welcome back. You're watching Be the Boss of Your Money. I'm Mitch Goldberg. I'm a financial advisor with Client First Strategy Inc., a wealth management firm. The whole point of this show is so that you can be the boss of your money, not your money to be the boss of you, which is easy to happen. We're going to talk about SPACs. It's the biggest thing like ever. People can't get enough of them. Is it a speculative bubble? Should SPAC stocks even be considered a separate class of stocks? We're going to talk about that. I'll tell you exactly what a SPAC is, what it means, and then you'll know what I'm talking about. And I'll just bring you up to speed real quick. First, I want to just acknowledge this. If you're watching this in the live, if you're in Team Live, you are welcome to ask me any questions in the comments. I would love to hear from you. Welcome to you. If you're Team Replay, you're watching this later on. If you have any questions, first of all, welcome to you as well. I'd love to answer your questions. So go ahead, hit me up in the comment section with your questions. I'd love to answer them. Just ask away as if you're watching this in the live stream. We have Anthony Ruffalo. Follow him, connect with him on LinkedIn, by the way. He creates some of the best financial content that you're going to find anywhere. Very educational. And this man, all right. Hey, man, great to see you. Thank you for joining me. That means a lot to me. You, my friend, you're a friend, man. I really appreciate that. Okay, so here we go. Let's do a quick share screen. You're going to like most of what I have to say. Can't say you're going to like it all, okay? So let's just do the quick share screen, quick market update. We're going to fly through this because I really want to get into the SPAC thing, okay? So the Dow had a mildly up day. Hey, but it was a pretty good day yesterday. S&P eked out a little bit of a gain. Hey, look, I'll take a 0.5% gain. NASDAQ up 1.42%. That's because tech stocks were up. The FANG M stocks, which I'm so sick of talking about, but they were up. We'll go over those. Russell 2000 was the big winner. It was the big winner of the day yesterday. It's the big winner of the day today. Money looks, Russell 2000 is an index of small cap companies. Small cap companies are typically more, they get more of their revenues domestically as opposed to large multinational companies. Okay. And they're more subject to the cyclicality of the economy. So if you start to see small caps rallying, that's a pretty optimistic sign that investors are saying after last quarter's disastrous GDP number that investors are gearing up for a recovery in this quarter. Welcome, by the way, to the fourth quarter. Today is the beginning of the fourth quarter. I still feel like we should be in July, but we're already into October. The VIX was up. The VIX should have been down. See, there's a VIX. I don't know if you can see that on your little screen. That's the fear gauge. Typically, when the market goes up, investors, large professional investors, feel better about things, so they spend less money hedging their portfolios. So you would expect that to come down a little bit. It went up a little bit, and I do think that is mildly concerning, not overboard concerning, just mildly concerning. So it bears watching. I'm not making any decisions based on that. Let's take a look at the FANG M stocks. Okay, that's Facebook was up almost 2%. Amazon was up over 2%. Keep in mind, 2% for companies big as Amazon is just a massive amount of money. Hey, I'll just take 1% if they want to give it to me. They still have 99%, right? Amazon up, Netflix up 5.5%. It's a big move, big ass move. Google. Did I say that on live stream? This is like cable TV, right? So I guess I could say that. Google was up. Microsoft was up. Listen, when these big six stocks go up, they pull the whole market with them. When they go down, they pull the whole market with them. So you can't help but have a decent day in the market when these stocks rally. These are the FANG M stocks, the M for Microsoft. Reopening stocks were also pretty good, though. American, United Airlines, Delta Airlines had a decent day. Carnival was off a touch, considering that the CDC said they don't want any. They're going to extend their, ban on cruises for the rest of the year. These stocks were held up very well on that news. Yes, granted, they've already been pounded, but if they're actually going up a little bit or holding up okay on really bad news, that's probably a sign that they're washed out. Probably. I can't promise you that. Planet Fitness up 3%. Cinemark Holdings up a tad bit. That's a movie theater chain. Southwest up. Marriott Hotels up. So this was a good day for the work from home, stay at home stocks. It was a good day for the reopening stocks. So overall, today was just generally a good day. Why? I think talks of stimulus, Nancy Pelosi and Stephen Mnuchin are talking about getting they call it their last ditch effort to get a stimulus going. I think all incumbents need a stimulus to look like they're doing something to help their fellow citizen in the economy. So I think they get something done, and I'm definitely optimistic on that. So let's take a look at the sectors. Real estate was a winner, but communications was a winner. That's really, like, to me, a tech ETF. It's half Facebook and half Google, a little bit of Netflix in there. Discretionary was up, technology, utilities. It bothers me that industrials were down a little and financials were barely up. You really need to see financials do well. The news yesterday was that the Federal Reserve said, hey, we're going to keep very strict limits on what the banks could pay in terms of dividends and what they could spend on buybacks. And it looks like a worry thing from the Fed that they want to make sure that these companies are holding on to their cash if they need it to get through a market shock, as opposed to buy back stock and pay out dividends and then go hit the discount window for overnight money. Okay, so that's really what that is. Okay, we already went over that. I want to take a look at SPACs. I'm going to stop the share screen for a second. All right. It's like a freaking tongue twister. Special purpose acquisition corporations, also known as blank check companies. So this is when some very smart, sophisticated people, supposedly or presumably with a great track record, will go hat in hand to investors and say, hey, give us a ton of money right now, and we're going to hold on to that money, and we're going to look for an operating company to either merge with or buy that's already publicly traded, and we're going to invest the money in that. And then that's how we're going to go public. That's how we're going to go public. We're going to like back it in like a reverse merger. These are like all terms that were really big in the 80s and the early 90s. I graduated college in 89, and that's when I got into this crazy business. Very different business, though. I don't even feel like I'm in the same career that I was in 30 years ago. That's a story for another day. The industry is so much better today. The quality of the people in the industry is so much better. It's just, I love the business, and I love my colleagues, which I wouldn't be able to say that 30 years ago, but today it's just a great place, great industry to work in. So anyway, you could say, well, why don't they just say, hey, if you find something really good, then let us know and we'll send you the money. It's not how it works. When these companies, these SPACs, raise money to make their acquisition, special purpose acquisition company, they want to hold on to it. They usually charge fees on that. And then it's just they're at the ready to either merge into a public company, buy a public company, not just an operating company, but they want a venue or a backdoor approach to get into the stock market, to be a trading company, a public traded company. So just a couple of notes here. There are a couple of good articles. If you look up SPAC and you Google it, there's a ton of stuff on it. It's mostly the same. They'll tell you that this stuff was, SPACs were hot in the 80s. They're blank check companies because they're best efforts companies. Typically speaking, the management of a SPAC, they typically have about 18 to 24 months to make a move. If not, they return the money back to their investors. So they're really incentivized to make a deal, because if they don't make a deal, then they don't really get the big payoff on all the fees and stuff. So hopefully they're making a deal because it's a good one, not because they, are running out of time and they feel under pressure. All right. To me, it's kind of like private equity, like an exit strategy for private equity investors in a way. And I think they're pretty speculative. Companies do SPACs instead of going the traditional IPO route. Because, well, first of all, SPACs don't actually have an operating business. They're looking to buy into a business or buy an entire business or take control of an operating business. So they're just looking for something really good. And you have to have a lot of confidence that the managers of SPACs are going to be really good investors, and that they really know what they're doing. But just because you have an area of expertise, like you could be a great accountant, you could be a great financial advisor, but it doesn't mean that your CPA should be picking your investments, and it doesn't mean that your financial advisor should be doing your taxes, because you don't want to end up broken and in jail, right? So I think people have to stay in their lane. But anyway, they are different. They're a little complicated, but it's supposed to be a way of letting smart money buy a company go public. And when they go public, it's kind of like an IPO. The stock goes up and everybody's happy and everybody makes out great. That's the fairy tale part of it, but they do work sometimes. But once they start working, it attracts more and more. So lately there've been a ton of SPACs. So without boring you too much more, I'm going to do another share screen. And this is why I'm doing this, because I found out about this today. All right. I found out about this today, and it's like you're probably going to get pitched in some way. A sales pitch is going to get thrown at you about this SPAK. This is the new, the first SPAC ETF. It's a nice graphic, and the reason you have sports on it is because Draftkings and Virgin Atlantic, these are SPAC companies. So is Nikola Motors. You may have heard about that. GM put a ton of money into it. Everything was going great. The stock rocketed higher. It was a big stock on Robinhood. And then the stock just got absolutely mauled. The CEO had to give up some of his compensation. He had to step down from his position. And then there's some, allegations of, sexual harassment on his part in the company. And it's just really become a freaking mess. So let's just take a look at some of the common SPAC companies. Okay, so here's DraftKings. The low on DraftKings is 9 and change, and now it's over 60. So that is 600% gain, and you look at that and you go, wow, SPACs are awesome. But then you look at Virgin Galactic Holdings, symbol is SPCE for space, and that's gone from 6 and change to 42 back to 20. So that's really tanked. And that move happened pretty recently, when straight up it went on a rocket ship right higher, no pun intended, and crashed and burned lower. And then you look at Nikola, which went from 10 year low of 10, 52-week range, 10 to 93, almost 94, down to $24. I mean, this is what I mean by this is speculative stuff. I mean, I don't know if people really understand what they're buying. And this is why it makes me think that there's a lot of areas of the stock market that are very bubbly, and bubbles pop. I mean, hey, don't get me wrong. I love a good bubble as long as I'm in the stocks before the bubble happens. Then bubbles are great. But people usually don't know about these until they go up. And I think the difference between there's a point when a stock goes up on either fundamentals or expectations of improving fundamentals. And then what happens is it changes to a bubble, or let's say at least overvalued, when investors go from buying a stock based on improving fundamentals or expected improvements in fundamentals to buying a stock because it's just going up. In other words, stocks should go up, a cause and effect, if you will. Improved financial metrics, improving fundamentals drives a stock higher. Or what happens is the stock goes higher because investors see the stock going higher. So they went in on the action because the stock is going higher. They interpret that to mean everything is good. I don't have to do the homework. But if that's the only reason why you're buying a stock, that's when you get into trouble. It's called momentum. That's what momentum investing, momentum trading is all about. Okay, so let's get back to this ETF. We're almost done, folks, believe it or not. So SPAC, the first SPAC ETF, not space SPAC, special purpose acquisition corporation, from a company called Defiance ETF. And it's a SPAC of companies with no commercial operations. So there's no commercial operations that are established solely to raise capital from investors for the purpose of acquiring one or more operating businesses. Why invest in them? I think this will give you, this website, the sponsor of this ETF, will give you a lot of really all the good stuff. But I don't think they're going to give you all the bad stuff. I think the fine print is in there, but you're going to have to read the fine print and look for it. Okay. So far in 2020, SPACs have raised $22.5 billion. There is a famous hedge fund investor named Bill Ackman. He just raised something like $4.5 or $5 billion, maybe $6 billion. Let's say around $5 billion for a SPAC, which is the biggest raising ever, the biggest money raise ever for a SPAC. He did say he's not going to take any fees from it until, or only if they actually make an acquisition. He happens to be a multi-billionaire already, so I don't think he really needs your fees. But by the way, when I say your fees, if you're watching me, I hate to say, you're probably not in on that one. Okay. Why a Defiance SPAC ETF? Well, obviously you say an ETF, so you say instead of buying one or two, you buy a package of 29 of them in this case, and you get broad diversification. I don't think buying a SPAC ETF gives you diversification in the way you think. Diversification is a strategy that you use to reduce risk. It prevents your worst investment from being your only your entire return. But it doesn't prevent your portfolio from going down in a generally down market. It's not a strategy to increase return. That would be the opposite of diversification. Okay, that would be a concentrated portfolio. But it's still all the money's going into SPACs, and I think SPACs are, generally speaking, it's a very aggressive, some will say speculative way to go. So I want you to know a little bit about this, because this is going to be pretty popular. It'll probably be spoken about in the media. I could definitely see this being talked about, on CNBC and the other, financial outlets. Here's the tear sheet on it, the fact sheet. So, and the companies that'll be in it, they'll tell you Draftkings, Clarivate. I think I pronounced it right. Vertiv Holdings, Vivint, Smart Home, Open Lending Corp. But these are all SPACs, and I think that you need to really be careful. This has just become very popular stuff, but I look at this as a sign that because interest rates are so low, it's gotten a lot easier to raise money for aggressive / speculative ventures. These are, here's the word I was looking for, blind pools. SPACs are like blind pools. That was a real big term in the 80s. And a lot of people got hurt with these. You're not buying Procter and Gamble and Disney and other high quality stocks. You're buying what I think could be very expensive assets because these SPACs have to pay up for the assets. They've got cash burning a hole in their pocket, and I just think that the low interest rates. That's why I brought up crypto, which went up and then crashed. Pot stocks went up and crashed, and I think that what the Federal Reserve has done is that they're really good at getting money to move from one area in the market to another, and they're creating these bubbles and bursts left and right all over the place. So buyer beware. I can't stress that enough. If you have any questions about this, you're welcome to call me direct. Will I be investing my own money into this ETF? No. Will I be recommending this to clients? No. This isn't really my kind of thing for my clients, and I think there's enough, you know, real companies, I like to call them, or companies already publicly traded available. There's plenty to choose from. If somebody calls me about this, if a client says, "Hey, what do you think?" I'm going to tell them exactly what I just told you. Ultimately, if you want to buy it, it's your decision. It's a free country, and kind of thing. Just make sure you're not working with money that you can't afford to lose. Yes, that should go with everything, but this, I certainly that goes with any kind of investment. But if you're generally, investing for the long term in your 401k plan or something like that, you're generally not buying a SPAC ETF. You wouldn't even find that option in a 401k plan. So that's what I mean by that. So thank you very much for watching. I will be out on Monday, possibly Tuesday. I hope to be back by Wednesday or Thursday next week. And I will see you soon. Thank you so much for watching. I really love doing these live streams, and I really just find the idea of sharing value with you to be incredibly exciting to me. So I hope you got value out of this, and I will speak with you next week. Thanks.